Hi everyone, welcome to the world of smart investments. I hope we saw the first part of this video about joint corporation investment deal. In this video, we continue our value analysis, our fair price analysis, and forecast of prospects of our deal. For those who don't know me yet, my name is equity-ROE. I am general partner, co-founder, and investor of Equity Capital Partners. We begin the study of financial statements with the dynamics of the two main indicators in any businesses: return on equity and return on invested capital. What we would like to see given our assumption of a sustainable competitive advantage in JoYY Corporation. Firstly, return on equity and return on invested capital more than 20% annually. Second, persistent of upward trend in these indicators. Let's compare what we want with reality. Since the initial public offering in 2012, JoYY has shown fairly high numbers ranging from 93% to 8.44%. This number series cannot be called stable. The range is wide, which is typical for young growing businesses. Moreover, in 2018, return on equity and return on invested capital sharp decline is alarming. Here it's very important to understand whether this is a one-time solvable problem or it will become a negative trend. Therefore, we look further and look for explanation in financial statements. The most important indicator showing us how effectively top manager reinvest retained earnings is return on retained earnings. This is indicator of the quality of management, and here in JoYY Corporation everything is fine. This indicator equal 20.8%. We move to the first lines of JoYY's Corporation income statement and analyze the revenue of the last 10 years. We see a beautiful picture of an ever-growing trend and impressive compounding annual growth rate of revenue plus 98.5%. If we take the last years from 2016, we see a slight slowdown in growth rate of net revenue. Compounding annual growth rate for those period plus 38.6%. It's natural that with the growth of the company's capitalization, the growth rate of revenue will slow down. Nevertheless, in the second and third quarters of 2019, revenue growth was plus 66.8% and plus 66.2% respectively. Looking at the dynamics of gross margin by segment, it becomes clear why return on equity and return on investment capital in 2018 decreased significantly. Group level margin impacted by mix of business. Here, it's necessary to remember that JoYY Corporation acquired bigger in 2018. The bottom line is that bigger gross margin is significantly lower than JoYY Corporation core businesses. When company merge, the total gross margin is averaged. That's why we see a decrease in gross margin to 31.5% in third quarter of 2019 from 39.3% a year earlier. Analyzing operating expenses, we clearly see that there are two periods. The first from 2016 to 2018, while operating expenses ranged from 15.5% to 17.1% of the revenue of the JoYY. And the second period that began in the second quarter of 2019, while the JoYY fully acquired bigger and therefore the income statements of both companies were combined into one. We need to understand that bigger is a startup company that is the stage of rapid growth and scaling. In this phase of business development, the cost associated with marketing and sales, as well as research and development, are quite high. Compare how the structure and total operating expenses have changed. This increase in operating expenses naturally lead to a decrease in net income and net profit margin in 2019. This explains the reason for the sharp decline in return on equity and return on investment capital in 2018 and 2019. But for us, as investors, it's important to understand the dynamics of the net income and its growth over the past 10 years. We see a constant growth of net income on compounding annual growth rate plus 70.79% over 2012 to 2018. It's a very important moment because it confirms our idea on the long-term sustainable competitive advantage of JoYY Corporation, and this is just what we need. On this slide, we see how the bigger and JoYY merger deal affected non-GAAP net income and net margin. GAAP means general accepted accounting practices. We believe that this deal will also reduce the net income of 2019 and 2020, taking into account also the situation with coronavirus and the global recession in 2020. Analyzing the balance sheet at the end of the third quarter of 2019, we note the total cash reserves 24.9 billion renminbi. Renminbi means Chinese internal currency. Covers the total liabilities of the company 12.3 billion renminbi, more than 2 times. This is a good sign of the financial security and reliability of the company, especially on the eve of the global recession. We always take this into account together with ever-growing operating cash flow in risk analysis. In addition to the above, in risk analysis, we take into account the total liabilities are fully covered by 2 years net income. Return on retained earnings equals 20.8% and ratio CapEx, capital expenditures, to net income was 30%. All of these criteria match our target ranges. Now let's look at the trends of the market in which JoYY Corporation is doing business. Experts' prognosis reveals total market compounded annual growth rate plus 16% for period 2018 to 2023. Non-game live streaming segment has more potential for growth. A main key driver of potential growth is short-form video. In this diagram, you can see that in 2015, the number of monthly active users in short-form video segment was only 112 million. In 2018, already were 826 million of months active users. It equals plus 94.9 compounding annual growth rate over period 2015 to 2018. Experts estimate 3.5 billion of monthly active users in 2023. It will equal compounding annual growth rate plus 33.5%. These data are for the global market. And in this situation, it should be borne in mind that overseas monetization still in early stage with huge potential for growth. Overseas users account for more than 87% of all users in current time, but they only contribute less than 20% of revenues. On this slide, you see global short-form video monetization potential from 2015 to 2018. Compounding annual growth rate of revenue was plus 213.4%. Expectation for the period from 2018 to 2023 is compounding annual growth rate plus 55.6%. Currently, mainly a proven powerful monetization model via virtual tipping is used. Currently, advertising and e-commerce models take very little share. Therefore, potential for growth is huge. Using 5 years discount cash flow model, we figure out the fair value, so-called intrinsic value of JoYY Corporation. $89.70 per share, and it's based on the most conservative assumption. Our price of buying was $57.76 per share in December 2019. Thus, a margin of safety was 35.6% in December 2019. Given earnings per share for the last years, $3.64, we can calculate our initial return on invested capital. Initial return on invested capital means return for the first year after buying. You can see formula for calculation on this slide. Thus, initial return on investment capital equals 6.3%. What does it mean? It means that we bought part of JoYY Corporation earnings with initial return on investment capital 6.3%, which will grow based on compounding annual growth rate plus 35% over the next 5 years. Remind you, we took the most conservative scenario. What do we have in total? JoYY Corporation is a global fast-growing company with long-term competitive advantages. We assume, based on conservative scenario, potential compounding annual growth rate plus 35% over the next 5 years. This company is undervalued significantly. I would like to focus your attention on the fact that we don't predict how much JoYY Corporation stock will cost tomorrow or in a month. We don't know it. We estimate a future free cash flow, and after that we calculate intrinsic value based on such estimation. We assume that the stock price of JoYY may decline in the near future. If this happens, we will be very happy, and we will continue to buy more shares below $57 per share.
I hope this material was valuable for you. If you have a real passion to expand your experience and create real investment results, please apply to our mentorship program, Equity mentorship program. Invite to this program. This is a real incredible investment program. This is a revolution in business education. I invite you. And now, share this video to your friends, write comment below this video, and see you next video.